Hello, welcome to Adam's Swing Trading Masterclass, Unit 2. We're going to be looking at market behavior today, Bitcoin and alts together. Disclaimer, any views or opinions in this course are strictly my own. I'm not a financial advisor, this is not financial advice. Tactics, strategies, philosophies, and fundamental principles here are mutually exclusive with material presented by the other professors. This is because my methods target different goals to theirs using different data. The learning objectives for today are going to be looking at Bitcoin. We're going to be doing a bit of a deeper dive now, looking into the nature of the beast. It's going to be a bit more complicated than Unit 1, but we'll take you through it step by step. Learning objective 2, Bitcoin signal. We're going to be extending some analysis from Unit 1 and looking at some deeper principles here, preparing you for further lectures where we go into a super deep dive onto all the different indicators and data sets I use. And number 3, the altcoin market cycle. First up, I'll have a look at Bitcoin. First of all, there's no conjecture on the subject of Bitcoin's volatility or extreme historical performance. Bitcoin is the yardstick that all cryptocurrency investment performance is measured against. Bitcoin's volatility is extreme. With timing, an investor could have caught 27,000, 6,000, 1,000, and 8,000% rallies for a cumulative 1,295,999 blah, blah, percent. Yes, you read that correctly. I've done the maths myself. Avoiding the drawdowns and selling at the peaks would have grossed an investor over 1,000,000,000% over the last 10 years. Of course, that would take a little bit of skill. The volatility of Bitcoins persistently exceeds that of any other major asset class. Gold, S&P 500 stocks, currencies, or anything. Even oil for the most part. Volatility is the lifeblood of opportunity. This is why Bitcoin acts as a giant magnet for the attention of enterprising individuals thirsty to exploit those opportunities. This is a good example of pretty much the highest performing asset, second asset over the over a time frame you're trying to force. This here is ticker code TQQQ, which is the triple leveraged Nasdaq. The Nasdaq stock market index over the last decade really has been the highest performing stock market index in the world, and this is the triple leverage version of it down here in the orange. You can see that it's only returned a measly 7,500% over the last few years, whereas even when we're fitting it to try and make the stock index as high performing as possible, Bitcoin still beats it with a 2,000,000% return. So obviously Bitcoin is the daddy of all returns. Even this one, for example, where we start at the very beginning of this data series, you can see that it opened with a drawdown to give everything else a head start, and yet we still beat all these other assets and individual stocks that have performed very well over the last several years as well. So what you performed very well over the last several years as well. So what you're looking at here is what's called a distribution, or it's kind of like a histogram. It's a distribution of the price returns. These are the daily price changes. So this is a good way of understanding the market from a way that I view it. You can see that the normal distribution in green is actually what the price returns for an asset should look like. This is kind of prescriptive. Most assets don't behave like this, even stocks, for example. But you can see here that what actually happens with Bitcoin is that a lot of the time, not much happens, which is all of the return distributions are clustered around 0%, slightly above 0%. But then occasionally, very rarely, a lot of things happen. You've got massive price movements on single days, up or down, and you don't really have a whole bunch of the mid-range stuff. Either nothing really happens or massive moves happen. This is typical of stocks, actually. So this is called kurtosis, where you have an enormous discrepancy in the distribution. However, you can still see that if you were fitting the normal curve to this, you could modify it slightly to bring the edges in here. Yeah, so just remember that it's the Bitcoin market is punctuated by enormous moves and then a whole lot of nothing. Right. So if we're actually taking the price returns and we start to look at it over longer periods of time, you can see here the daily returns. This is kind of like the previous slide. Not a whole lot of anything happens, and then as we get to weeks, it starts to spread out a little further, and we have big weeks and small weeks. But as we get out into monthly returns, you can see something very weird starts to happen, and the distribution gets skewed right out to the right-hand side on the positive returns aspect of it. Now, this is an idealized version of that same curve. And when I think about the price behavior of Bitcoin, this is actually what I see in my mind. You can see here that, and please ignore the numbers. It's not accurate. I took this from somewhere else. You can see here that when we're investing in Bitcoin, what's actually happening is that the prices are constrained at a maximum loss. You can only lose everything that you have, but not more. But when you gain, you can potentially gain out to infinity. This is why sometimes Bitcoin is referred to as a call option, is because this payout distribution really gives you unlimited upside, but for a fixed downside potential. If we were actually drawing this with Bitcoin returns, this number 2 here would probably be a number 1 to represent 100% of your starting capital. And then you could go out to infinity, or you could go down to 0 capital. But you can double, triple, quadruple, all the way out, depending on how far you want to take it. So coming to terms with these behaviors is not quite complete until one fully considers the mathematical implications of Bitcoin's asymmetrical performance. Additionally, being a naturally unlevered asset, an investor can take on a fixed level of risk, maximum 100% loss, for hypothetically unlimited gains. Bitcoin is not a CFD. It's not an option, strictly speaking. There are no margin calls and there are no margin loans. It's just pure investment savagery. Now, let's have a brief look here at the quality of the returns. You can see here that if we're looking at high-performing stocks that you all know about, and stock market indexes and everything, this pink line represents equality between risk and return. This is the 1-to-1 line. So you can see here, if we're taking on 80% risk, we're going to be receiving 80% return, hypothetically, if our assets stuck along this line. What we actually want to see are assets that give us more returns than they do with risk. So you can see here that because Bitcoin is on the top of the line over here, it's actually, even though the risk is still quite high, we're receiving more returns than we are receiving in risk, which makes it an excellent asset. This displayed on a rolling basis over any 4-year period, you can see that there was actually no point in history where Bitcoin wasn't the superior risk-adjusted asset in the entire world, which is quite incredible, honestly. We have to have a quick look at drawdowns, though. Drawdown frequency is far more often than other assets, where every few years you can receive up to an 80% drawdown. You can see it's getting slightly less over time, but the average drawdown of about 50% can happen almost every year. So we need to be very, very careful with what we're doing, always thinking about what the worst case scenario is and positioning ourselves so that when we do receive giant drawdowns that we're ready to go. And this is pretty much what Daniel's dip buying bot is for. But within this within the context of swing trading, we're going to be looking at that as well. Okay, so let's look at expanding on the Bitcoin analysis from unit number 1, analysis philosophy. Quantitative versus qualitative. This one is very important to me. Quantitative essentially means numbers and numerical things that are factual data points. And qualitative is like stories, things that you're trying to derive from logic and reasoning and so on and so forth. You may notice when first learning how to invest that there is a lot of talk going on, ideas here and there, lots of opinions. Trying to derive a prediction using stories and the logic of other unsuccessful investors is no different to apes bashing rocks against other rocks. They think they're doing something, but no actual progress is being made. This is because stories come riddled with human cognitive biases and heuristics. The market deals in probabilities, not stories, in my opinion. In this respect, quantitative analysis is superior to qualitative analysis. pulled this picture of the mind because ultimately, if you're not thinking in the forms of principles, maths, and tested processes, really you're just kind of making things up, I believe. You'll notice that from Unit 1, I took the slide from Unit 1, you'll notice that when I went through analysis methods and their reliability, there wasn't a single qualitative method of analysis in this list. They're all quantitative. Every single one of these relies on some sort of data set, rule-based system, or maths. Because basically, if what I'm trying to do is I'm trying to take everything I do, and you, by extension, from a space of mostly made up stuff in faith, all the way up to empirical evidence. If you're smart, if you're a disciplined student, you'll recognize this diagram from a previous lecture, and you'll understand exactly where I'm coming from here. I won't harp on it too much because you've already seen this before, but this is critical because, like I said, this fits into my philosophy of trying to get rich for sure. We're trying to engineer and eliminate everything that can't be testable. Eliminate all this bullshit. We're trying to get rid of it. Okay, so let's get into some slightly more meatier stuff now. Some of you will recognize this again, but I just wanted to bring it up in the lecture so that you can hear me talking about it. There are 3 types of tactical principles when it comes to investing. Is it expensive or cheap? All right, this is the first one. This is the least difficult of the 3 different tactical principles of investing over a long period of time. So we're talking years here. It's hard because things that are very expensive can keep getting more expensive, and things that are cheap can keep getting cheaper. This is difficult due to noise and randomness, but it can be used in mean reversion strategies. You can see here, this particular one, beam indicator, very basic, is just to basically show how expensive and cheap works. You can see here that it would be useful for picking the top and bottom in this particular section of the market during this time. Wasn't useful recently, but this is a good indication of what I mean by expensive or cheap, overbought and oversold. And price trends. So is it trending up or down? This type of methodology is often wrong in ranging markets. You get whiplashed and you get tons and tons of false signals which eat away at your account. So it's wrong in ranging markets often, but it gives you exposure to large moves when they occur. It's harder than number 1, but it's still easier than number 3. In case you're curious about this one, this is nothing special. I cherry-picked this particular thing just to show the example of what a trend following strategy looks like. This one blew up the account over here and semi-blew up the account over here. Hypothetically, I didn't run this one, but yeah, just to give you an idea of what trend following is meant to achieve. Kind of basically what my entire strategy is meant to look like in practice. But it's all easier than number 3, which is predicting the future. Where is it going to go to next and when? Impossible to answer, but easy to ask. Hence why it's the first question most novices ask. They don't understand that it can't be done. No one actually knows where anything is going in the future, but we have probabilistic methods of entering and exiting the market when there is a high probability of making money. Fucking don't ask me for my price targets. Right. That being said, experience does give insights. This is one of the moments where I was kind of brought out from the fray within the war room. I made a call that would basically picked the top in Ethereum within a few dollars and warned everybody about it. It wasn't a part of my actual strategy at the time, but yeah, there was a lot of guys that acted on this and took their profits pretty much at the exact top of the market, thanks to my call, which I was very happy to provide that service for them. Was slightly less accurate on Bitcoin, but it still worked out quite well. So yeah, you can call that predicting the future. You can call it whatever you want. Essentially, it was just the spider's web of data points in my mind, all kind of coming together at the same time with experience. You can develop this too over time, but it takes a good understanding of the fundamentals first before you get too advanced. Now, this is one of the sheets that I use to track a lot of my information. You can see over here that some of the websites that I use for some of my my data points. That's all open right there. You can just basically copy and paste that into your browser and or like type it into your browser, do some searching yourself. What I'm going to be doing is I'm actually going to be going through every single one of these indicators and describing to you where it sits within my trading philosophy, the importance I place on them, how I use them, and how you can use them as well to make better decisions with your trading and essentially try and get to the point that I am at. Market correlation is another big one that I like, which it really doesn't have anything to do with overbought, oversold. It's kind of like in its own little realm, and it can get quite complex. I use this table here. I keep refreshing it all the time, trying to get the correlations from all the different asset classes: stocks, US dollar, gold, break evens, bonds, and the VIX, and just essentially comparing that to all the different assets. This leads to a couple of important implications. Bitcoin is correlated to major stock market declines. So I'll just go back 1 second. Whoop. You can see here that it's slightly correlated to the stock market at the moment. It's doing quite well. Bonds will ignore that for the moment. So Bitcoin is correlated to major stock market declines. Sometimes it's not really correlated to smaller declines, which is weird. It's only when the stock market starts to accelerate to a certain point where it's like a catastrophe that Bitcoin goes along for the ride. Therefore, watching for recessions and transient volatility in stocks can be of importance. So I cover this type of stuff when it comes to stocks in the stocks channel. I'm not super active in there at the moment, but there can be information that I'll be sharing in there on this. Some short-term moves in the US dollar can affect Bitcoin because, after all, Bitcoin is denominated in US dollar. If the US dollar becomes stronger, that's going to affect the ratio and actually bring down Bitcoin. So yeah, that can affect risk assets as well, and everything kind of feeds into itself. So that can be important to watch sometimes. Methods of detecting probabilistic price ranges in traditional assets to fully exploit correlations can be found at my fractal range or purchased from Hedgeye, which is what I use, to help you determine the likelihood of future moves. Correlation trading is not essential to swing trading, but it does help a lot, and it also gets you into that mindset of being able to kind of like I wouldn't say see the future, but like really get an understanding of like the behavior of the market, really the sentiment of the market, like through pure price. So you need to rely on external data sets less. The altcoin market cycle. This is the final learning unit of the learning outcome of the unit today, and this one's very important, very interesting. This is probably the most important part of the whole lecture today, so please pay attention. I'm sure you'll enjoy this. So this is a call I made when I noticed that Bitcoin was starting to rise a few weeks ago. There was a lot of people saying, "Oh, this is the recovery. This is the recovery." Believe me, there was a lot of talk about how this was going to come up as a Wyckoff distribution or accumulation or whatever the fuck it is, and it was going to break out in basically a straight line, like a copy and paste of this over here. Now look at my tweet. I said, I believe the recent outperformance of alts signals an unhealthy market environment, which may lead to a pullback revisiting the lows of the last week or two. Thankfully, I think it will just be temporary. This was not based on randomness. Nothing I do is based on pure luck. I'm trying to derive the probabilistic price behaviors using data, okay? So you can see that I was absolutely correct. Let's dive into how I did it. Altcoins and the market cycle. So the bull run starts when Bitcoin has a net positive demand money inflow. Bull market beginning. As time moves on, smaller coins which may have underperformed initially start to catch up and begin to outperform, moving down in market cap size. So it's like we're seeing ETH now. Everything else is still rising in the background, but we're looking at this from a parabolic logarithmic perspective here. So ETH is starting to outperform. Next, the alts start to outperform while ETH begins to outperform even Bitcoin, which is also outperforming. So it's like the rate of change in Bitcoin is increasing, but ETH is going faster than that, and alts are going even faster than ETH. This madness, this madness, in turn attracts degenerates who increase leverage and chase the maximum level of market beta to increase returns. For example, shitcoins like Cumrocket. This is a sentiment kind of measure, really. This series of relative performance accelerations leads to a climax of buying activity, marking the peak of the bull market, followed by a subsequent catastrophic collapse. This happens because leveraged positions become forced sellers to lower exposure as volatility increases on the upside and downside over here, because volatility gets absolutely out of control like crazy and people getting liquidated all over the place. This is what it looks like in practice. Back in 2017 through 2018 market cycle, you can see that Bitcoin in the blue ran up fairly smoothly and it was doing quite well. But as it started to get towards the peak, you can see that Ethereum starting to accelerate over here, but also other smaller, shittier, lower market cap coins are basically going in a straight line up like absolute madmen. Now, we're not going to go into why ETH lagged the peak in Bitcoin. To this day, I'm still not 100% sure if I'm being completely honest with you. It's still a bit of a mystery to me. But the market beta and the actual behavior of price returns down in this segment are absolutely crystal clear to me. So how can we use this? The implications is that for a sustainable market recovery, alts cannot outperform on the way out of the other side of a crash. To have a recovery led by alts would imply that we're still in the final phases of the last bull run, which would actually imply that we're closer to another crash than the beginning of a new rally. Fundamentally, this is a sentiment measure, and most people wouldn't buy alts at the top if they understood the dangers of high beta, because buying smaller coins to increase your gains when things are going up actually increases your volatility in both directions. Therefore, in peaked or downtrending markets, you actually magnify your losses by buying altcoins. This is an example of the recent dip where we have a whole bunch of different fucking mid-cap shit versus Bitcoin, and you can see that on this scale here we have massive, like you had double the drawdowns or more in your alts than you did in Bitcoin. This is due to their smaller size. So uninformed investors, this is an example, like when Doge starts to drop down, uninformed investors will look at alts and say, holy shit, if it goes back up, I'll make 100,000% now instead of just a simple 1,000%. However, they will also more likely lose the 99% of their capital instead of the 60% they'd lose in Bitcoin due to its larger size and lower volatility. People at the top, once they fucking buy in because they're degenerates and it starts going back down, they'll be like, oh yeah, but it's going to go back up, so it's going to be okay. Hence the meme of everyone pretending, but really behind the scenes, they're fucking freaking out. And once the pain is too great to handle, uninformed retail investors say, I can't take it anymore. The anguish is killing me. And they rotate back into Bitcoin in a desperate attempt to conserve their remaining capital. And this is where the plan goes to shit. You can see here that from the same point that I had that in the last chart, that you still would have received a 50% decrease on your account. And this is how every motherfucker feels when they're looking at this bullshit. Pisses me off. They lower their beta here. They lower the beta, market beta here at the very fucking bottom because they knew all along that Bitcoin is the king. Unlike their speculative alts, which until recently were outperforming. At this stage of the capitulation, Bitcoin begins to outperform as alts begin to underperform, thus marking the cycle bottom. So, in summary, when the price was coming up from this down here, this dip down here, as we're getting to the top, we're seeing rapid outperformance on a daily basis. Around here, a rapid outperformance of altcoins, and I was looking at that going, no, there's something not quite right about this. There's something not quite right, and in amongst all the other different measures that I was looking at, it was just absolute trash. So it didn't seem like that big of a deal to me. I was happy to make this call because it seemed quite obvious. Shorted, made a whole bunch of money. Didn't cover a whole bunch at the bottom, kind of flipped along over here. You can check my calls in the medium term channel. Everything I do is completely transparent. There's no fucking mystery. It's just hard work. So yeah, if you see a rally, if you're seeing a rally like this, and you're starting to see altcoins go absolutely parabolic, bad news. It's bad news. It's a bad sign. It's a sentiment measure. Remember, we're looking at something like this. Only the trash starts to outperform at the top. If you can only take away one thing, remember that. The trash outperforms at the top, and then everything goes to shit. All right. Thank you for watching. Prepare for unit number 3, where we explore the holy grail of altcoin analysis. Unit number 3 is going to be very intense. I've already got it made up. I'm going to record it straight after this one. So, yeah, if you have any questions about the lecture, which I imagine you probably would, yeah, jump into the Crypto General chat or Crypto Questions and hit me with the @tag. And yeah, I'd be more than happy to answer any of your questions. Cool. Thank you for that, guys. Talk to you soon. Hello. Welcome to Adam's Swing Trading Masterclass. This is unit number 3, coin selection, math versus stories. I've been looking forward to recording this one for a long time. I hope you guys enjoy this one. This may be the most important unit that we cover in the entire Swing Trading Masterclass. God, I'm looking forward to this. Disclaimer. Any views or opinions in this course are strictly my own. I'm not a financial advisor, and this is not financial advice. Tactics, strategies, philosophies, and fundamental principles presented here are mutually exclusive with material presented by the other professors. This is because my methods target different goals to theirs using different data. So, money is numbers. Math is the language of numbers. Therefore, to speak money, you must speak math. Now ask yourself, do you want to speak money? This is going to contextualize everything that we're looking at today, because math is money, numbers. You're going to need to want to learn this stuff, because you can't rely on narratives and stories forever, like a goddamn caveman. We're intelligent investors, and I trust that if you guys come across something you don't understand, that you'll be fucked to literally learn the fucking maths, because there's no other option. So what we're learning today, correlation, how everything is connected, and modern portfolio theory. We're going to look at what is the best altcoin. So, correlation first. As you may already be aware, within the cryptocurrency universe, Bitcoin is actually the slowest moving and the lowest returning cryptocurrency in the entire market during rapid pumps. For the novices, it's only logical that if you want to increase your returns, you'd start to look into them. So you start digging, excited by the prospect of an easy 10x, 1000%. So you do some surface level research and you come to me with questions like, hey Adam, thoughts on XYZ token? I heard it does this new thing that, but it has a better technology than this, and I'll clap back with something else, and you'll go, okay, I get it, but the project has support from this well-known coder or engineer or celebrity, blah, blah, blah. And you'll see me hitting you with this. Boom! Motherfucking correlation table. Let me hit you with this. Nothing matters except the data. This is a wake-up call. You've been lied to. You've been misled by the popular media to think that qualitative things matter. I want to remind you that nothing matters except math, which is the language of finance, and therefore it's what puts the money in your pocket. Today we're going to upgrade your reasoning. So, first of all, I just want to say to you guys that I do want to make the maximum amount of money possible. I'm autistic, not retarded. So I do not care what XYZ token does. Your tokens may as well be called token 53 and token 54 to me. And we have no other data except their price. To me, they're all the same trashy mathematical problems waiting to be solved. And that is a problem of returns, correlation, and volatility that we can solve. So altcoin fact number one. Fact, everything is correlated. Now, if everything is correlated, then there is no purpose in using more than one asset unless you're employing a rebalancing strategy, which 99% of people are going to be too lazy to adhere to anyway. That includes me. Even if you did employ that strategy, risk-adjusted returns would be minimal. So, what I'm going to do is I'm going to show you how to read this correlation table, because I've had a few people come to me and ask me how it works. Basically, correlation is a score that runs from +1 to -1. +1 meaning perfect correlation, where two assets move in perfect harmony together, in perfect sync, and they move in the same direction at all times. They can move at different magnitudes, but their direction is identical. If you have something that's -1 or completely uncorrelated, if this whole thing was red, then that would mean that every single altcoin moves in the opposite direction to Bitcoin at all times. And when Bitcoin goes up, the altcoins go down and vice versa. And this effect would swap over consistently. What you can see here, we'll focus on the bottom left-hand half for the moment. You can see here that the entire correlation table between all, not only Bitcoin and all these other altcoins that I have listed here, not only that, but they're also all correlated between each other to a very high degree. There's almost no scores in this table that are below 0.5. 0.5 being very strong correlation, anything above 0.5. You can see here that Bitcoin is very strongly correlated to everything. And as you can see as well, Ethereum is the one that is the strongest correlation to Bitcoin. We'll come back to that at another point. But I want you to take note of that. This correlation matrix is from August the 4th. I did check it today as well before I did this lecture. It's basically exactly the same. Everything's the same. You can see Litecoin here. I'm not going to ignore it. It is quite strongly correlated. We'll come to that later as well. But yeah, Ethereum, again, today was the highest one on the table. On the top right-hand side of this correlation matrix, what you can see here are some lines that move above and below the midpoint of this box in here. What this signifies is the statistical significance of said correlation. So you can see that the statistical significance of all of these different correlations is quite high, which means the reliability of the correlations are quite strong. You can see here that Ethereum, for example, is squeezed right up against the top edge of the box here, above the midway point, which means that it's a very significant correlation. If this was high, if we had a high number, 0.85, and the significance was below the midway line, it was down here, that would be a clear indication that we can't take this number seriously, and that none of these correlations are very strong or persistent or reliable. You can see here, though, that the entire right-hand side of the table of the matrix is full of very significant readings. This screams to me highly correlated market. This is a matrix that I have been following for a long time, for years, and I have never seen the market really become very uncorrelated, except for maybe in speculative peaks. It's super, super rare to have the entire market become uncorrelated at any point in time. 99% of the time, it's going to be highly correlated. So, should be number 2. Moving on to modern portfolio theory. Altcoin fact number 2. Searching for alts is useless. Now, I'm not in it for the tech or the story. I have no morals. I'm here to make money. You should be too. Using financial mathematics, we can literally calculate the single best altcoin to invest in, since the entire market is correlated. No one else on the planet will ever teach you what I'm about to teach you, because everyone's stupid. So, We're going to spend a bit of time on this one. This is modern portfolio theory. This is essentially the holy grail of asset selection. And we're going to move through it one step at a time. You can see that on the two axes, we have expected return and we have standard deviation. Standard deviation, for those who do not know what this is, means variability in the price returns. Therefore, if you have a high standard deviation, there's a lot of variability in the price. If you have a low standard deviation, there is not much variability in price. The holy grail of any asset would be to have the maximum amount of return for the minimum amount of variation. Variation in returns is risk in financial terms. So what we want is something that's all the way over here and all the way up here. We want something up here. This would be the ultimate asset. You would receive insane returns with no risk. Obviously, the market doesn't work like this. Often we receive very low returns and very high risks in things that are gambles. Now, as you can see, we have approximated, I've just thrown these in here approximately. I can hear people screeching in the general chat already. I've just placed some random assets on this chart here to show you approximately where I believe certain assets to lie. We have the largest of the large caps, which have very low standard deviation, but also the expected return isn't super high. And you can see that we have a general drift up here. General drift up to represent that even though you're taking on higher risk as you go further out to the right-hand side, you're also taking on higher expected returns. As of the time of recording this video, somebody paid $100,000 for a rock as an NFT on the Ethereum blockchain. Insane. And also super speculative. So what we can see here is that we have all the individual assets. What we can do is we can actually combine these different assets into portfolios, and as we combine them, some portfolios will exist down here in the cloud of different assets, but sometimes when we combine these assets together, they actually work better together, and they work synergistically to actually increase returns and reduce risk at the same time. If you perform this experiment and you take all the different cryptocurrencies that you can possibly buy and you put them into a supercomputer and crunch all the different numbers and you run a whole bunch of different simulations, you'll end up with, thousands and thousands and thousands, tens of thousands of different portfolios. And what you'll find is they form a cluster against this thing here called the efficient frontier that no combination of assets can exist beyond. It is called the frontier because nothing exists outside here. Despite the crunching of all the different assets in portfolios, it doesn't matter how many experiments you run, nothing can ever go past the efficient frontier. If you were to have a portfolio, you would want a portfolio on the efficient frontier so you could select from the optimal returns for any given measure of risk. So, that is the first step of modern portfolio theory, which is to say that what you want to do is you want to combine assets to form a portfolio so that you don't want to be taking on unnecessary amounts of risk. But remember that the entire market is correlated. So there's very little added benefit in taking additional assets into a portfolio and mixing them together. Really, it would be more effort than it's worth. So what you want to do, Jesus Christ, what you want to do is you want to try and find the asset that's closest to the efficient frontier, or the assets that are closest to the efficient frontier. If you want to take on more return, you may want to take on some Cardano over here and be like, well, no asset exists over here, but ADA is the closest one to the efficient frontier, so I want to buy this one. Or maybe NFTs are the closest to the efficient frontier over here, and there's no point in combining any other assets, so you'd select that one. But what we want to introduce here is the risk-free rate. This is the interest rate that you borrow money at or loan money at. This is essentially the cash rate. So what we do is say, if this is 1% over here, what we do is we take a line and we move it out until it's tangential to the efficient frontier. This is called the capital asset line, and it rests against the point on the efficient frontier where you have the optimal portfolio, the tangency portfolio. This portfolio of assets, whatever their combination may be, has the highest Sharpe ratio of any combination of assets along the efficient frontier at any point. What this also means is that if you find the portfolio that rests at the tangent of the capital asset line and the efficient frontier, what you can do is you can actually borrow money at the risk-free rate and leverage up the optimal portfolio to infinity, which would be the rational choice. Also, you can go the other way and you can actually hold less of the optimal portfolio and more cash. And you can see here that as you're moving along this line, you're actually receiving a portfolio risk and return profile that exists beyond the efficient frontier. Okay? So you've managed to find a way of combining leverage or cash to get a portfolio that's more efficient than the efficient combination of assets that the supercomputer crunched. Now you might be asking yourself, Adam, I don't understand. What the fuck is a Sharpe ratio? Well, I'm about to tell you. The tangential portfolio has the highest Sharpe ratio, and it's calculated from this formula here. It's essentially returns minus the cash rate over the variability. You want the maximum amount of returns for the minimum amount of variability possible. Pop quiz. Out of these two different sets of assets, which ones do you think would have the highest Sharpe ratios? Would it be the one you see on this one? These are two great examples. These two assets over this time horizon had the same performance, but one reached that same level of performance with less variability than the other one. The other one had to go through a whole lot more variability to receive that same amount of performance. Therefore, it was IEF, it was bonds in this example that have the highest Sharpe ratio between stocks and bonds. That's an easy enough one. And on this one over here, we have two different strategies, strategy 1 and strategy 2. You can see that one returned much higher than the other one, despite them both having approximately the same amount of variation, risk or variability in the price returns. So if you were to pump that through this one, we would have an asset or a strategy, whatever the fuck it is, it has the maximum amount of return for the same amount of risk or variability. So it is the portfolio or strategy with the highest Sharpe ratio. You can see that when selecting between assets or portfolios or strategies, the strategy with the highest Sharpe ratio is the one you want to go for. No rational investor would willingly choose something that performs worse. So what I'm going to do right now is show you some Sharpe ratios on TradingView. We're going to go between some assets and we're going to have a look. So I've got it all set up here, ready to go. I want you to pay careful attention to these two numbers here. Pick one. I don't care which one it is. I prefer the purple one because it's the longest run Sharpe ratio of these different assets. We have Bitcoin first up. 2.6. Make a mental note of that. I'm going to go through a few different ones here, see if we can get some price history. Not enough price history. I'm going to go AVE. 2.9. Not enough price history. 2.9. Some altcoin trash. 2.5. Zcash. 2.2. Link. Not enough price history. 1.3. It's still quite low on the high frequency one. 1.6. Litecoin. BNB. 2.7. Ripple. 1.6. Doge. 2.8. Uniswap. Not enough price history. Decred. 1.5. ICX. 2.5. 2.2. Verge. 2.1. Shitcoin. XRX 2.2, 2.4, whatever, 1.4, and then we choose Ethereum. Oh look, 3.1. Isn't that funny? Out of all the different cryptocurrencies, Ethereum has the highest Sharpe ratio, even higher than Bitcoin itself. So you tell me now, where does Ethereum lie on the efficient frontier? Comes obvious now, doesn't it? So, the only logical conclusion. Correlation renders diversification in the cryptocurrency market mostly useless. In a competitive market, a rational investor will only hold the optimal portfolio. Because correlation in the cryptocurrency market is so high, this statement can be modified. In a competitive, highly correlated cryptocurrency market, a rational investor will only hold the optimal asset. Since Ethereum displays not only the highest correlation to Bitcoin, which gives us a high signal for our fundamental analysis, but also the highest Sharpe ratio and includes supercycle dynamics, which I've explained in detail in the long-term channel, it is the optimal asset. Now I can see people in the fucking chat already losing their goddamn minds. I can feel it coming through the internet right now. I swear to God, I don't give a shit about what you think about any other altcoins. I don't care about your stories. I don't care about your feelings. Now, that being said, I do recognize that there are variables in place for marketing, for hype, things that can cause altcoins to outperform over short periods of time. But in case you've forgotten, I want to bring it back to this statement that underpins everything that I do. It's not just about getting rich. It's about getting rich for sure. If I cannot model what I am doing, it becomes a gamble. I am not in this game to gamble. You guys got to understand, I've made all this money because I've engineered out all of the luck out of my process. It's about making decisions that make sense. I can't give it to you any clearer than this. I hope you got something out of this lecture today. I swear to God. If you have any questions, please reach out to me. Prepare for unit number 4, where we explore the holy grail of Bitcoin valuation and continue this swing trading masterclass. We're going to be moving forwards now. We're going to be going very deep into analysis so that we can extract the maximum amount of signal from Bitcoin as possible. Apply that to Ethereum and then build a process around position sizing and timing so that we can extract the maximum amount of money from this market. If you have any questions, please jump into the Crypto General chat or Crypto Questions and hit me with the @tag. Looking forward to providing more information for you guys soon. Thank you very much. Hello, and welcome to Adam's Swing Trading Masterclass. Today is unit number 4, which is the long-term core component of the masterclass where we look at the stock-to-flow ratio. Disclaimer, any views or opinions in this course are strictly my own. I'm not a financial advisor, and this is not financial advice. Tactics, strategies, philosophies, and fundamental principles presented here are mutually exclusive with material presented by the other professors. This is because my methods target different goals using different data. So, first up, macro view and price signal. To perform any type of analysis in a correlated cryptocurrency market, we must start at the highest level. I believe that begins with the stock-to-flow model. A solid understanding of future probabilities allows us to formulate rational expectations which inform things like our timing and position sizing. This analysis is what I call the signal and is the foundation of the enhanced long-term philosophy used in my swing trading. Extracting signal from Bitcoin data is the work done behind the scenes to gain an understanding of what price probabilities we are faced with moving forwards. So this slide here is extracted from unit number 1. You can see that what we're going to be looking at today is based on the fundamental laws of economics and a mixture of that and on-chain data. If you're thinking back to that unit 1 lecture, we're going to be trying to move down this list here in sequence and then go back to the beginning again to do the systemization at the very end of the masterclass so we can tie everything together. So the learning objectives today, what is the stock-to-flow ratio? Stock-to-flow model as a price estimator and stock-to-flow criticisms. So what is the stock-to-flow? Quantifying economic scarcity. Traditional long-term valuation. For traditional financial assets, such as stocks and bonds, it has been fairly easy to approximate a fair price for the asset as a function of its expected future cash flows. Because Bitcoin doesn't generate any cash flows, we have to find another method of modeling its value. I'm just going to give you a quick primer here in economic supply and demand, which will give you a little bit of an idea of what we might be looking at today. This isn't directly applicable to what we're looking at, but it'll get your mind in the right space. So if you have never seen a supply and demand model before in economics, this is pretty much what it looks like. We have a demand curve and we have a supply curve, S0, D0, and we have price and quantity here on the two axes. What happens is if we have a sudden reduction in supply, the supply curve moves to the left. What this does is it moves the equilibrium market clearing price from point 0 to point 1, which means that if the demand curve doesn't change and there's no change in the wealth or the ability of people to purchase more, they have to purchase less if there's less supply. Not only that, but the price also rises. So you can see here that changes in supply dynamics can affect the market price and the quantity. This can work the other way around, where you have an increase in supply and that lowers the price as well. And you can have shifts in demand and supply all over the place. But essentially what we're looking at is the equilibrium. And the equilibrium moves around and shows us where the market will appropriately price that commodity or asset. So gold is expensive because it's scarce and in demand. But dirt is worthless because it's abundant and useless. So you may be asking, this all makes sense. But silver is also scarce. So why is the price of gold always higher? This can be explained with a supply and demand chart, sure, but it would only give us the instantaneous market price of the asset and would be mostly useless at forecasting future value. Thankfully, we can go one level deeper and model its approximate market value in advance using supply data. You can see how this would be useful for estimating the market value of an asset with no cash flows, such as Bitcoin. This is an economic principle relating to the total existing stock of an asset relative to the supply rate of new units flowing into the market. This relationship can be thought of as the total stock relative to the newly created flows, or the stock to flow ratio. So, just again, stock is the size of the existing stockpiles of reserves, and flow is the new yearly production. And this, we're going to do an example here. When this model was originally applied to Bitcoin in 2019, gold had a stock to flow ratio of 62, meaning it takes 62 years at the current production rate to get the current gold stock. Silver is the second highest with a stock to flow ratio of 22. This high stock to flow ratio makes them monetary goods. Keep in mind, it is very difficult to have a commodity with a high stock to flow ratio because if anyone hoards the asset, it becomes more scarce. It goes up in price, then production increases to take advantage of the higher prices, increasing the flow and bringing the price back down again. This is what happens to platinum and palladium. You can see a very low stock to flow ratios because the flow, it only takes 1 year. One year, you can literally see here of flow to match the total stock. So you can see the market is very reactive to the commodity. Bitcoin. If you've gone through the starting materials, then you'll already know Bitcoin's supply rate cannot be accelerated. Therefore, there cannot be an increase in production in response to investors hoarding the asset. With Bitcoin, a shortage of the asset usually results in higher prices, often dramatically so. Furthermore, the supply rate is predetermined for at least the next 100 years, meaning that while we cannot predict the future demand function for Bitcoin, we can know the supply function with certainty. And this is what it looks like. In this one chart here, we essentially have the Bitcoin stock, which is a cumulative measurement. We can see here it goes up very fast and then flattens off into the future. And then we also have the flow, which is the inflation rate. Newly minted Bitcoin, and it reduces over time. You can see here it gets cut in half in these different eras. This is approximately in the 4-year halving cycles. And yeah, we're to the best of my knowledge, we're in the 6.25 block reward era right now. And so yeah, in this one chart here, you've got the stock and the flow. So we can make a function out of that and essentially determine the stock to flow. Now you can see here within each halving era, it's not exactly smooth. We have a bit of variability in the inflation rate due to hash rate being added and taken away from the network, and the difficulty adjustment constantly oscillating to try and manage the inflation rate to get it as close to its average as possible. So it's never going to be perfectly flat because the Bitcoin network itself can't adjust that fast, and the hash rate's constantly jumping in and out. But you can see approximately it sits, at its predetermined rate. It just moves around a little bit. So when we go to this chart here, which is the pretty much the foundational chart of the stock to flow ratio, it's kind of explains why there's variability in the stock to flow ratio, when taking consideration that the inflation rate has a little bit of noise in it. So it will vibrate from side to side along this axis down here. And then the Bitcoin price itself, as the price of Bitcoin and the market cap itself moves around, it will oscillate up and down on this axis as well. The most interesting thing is when you actually look at the stock to flow ratio for any one particular month, and you look at the market value for any particular month, and you start to plot those together as a relationship. All these dots. And what happens is if you put a regression through these dots, you find it has a very strong linear relationship. What's even more interesting is that once plotted, you look at gold and silver up here, they sit very close to that linear relationship on that line as well, which at least initially suggests to us that not only does Bitcoin have a very strong relationship for its market price to its stock to flow ratio, but so does gold and silver. Great signs there. And so this is one of the foundational charts for the stock to flow ratio. I won't go through all the advanced maths to try and figure it out again to explain it to you guys. You can do that in your own time if you're interested. We'll go just one level deeper here. And this was the stock to flow cross asset model, where algorithmic clustering was brought in to essentially group the Bitcoin stock to flow ratios in each halving era. And you can see the green dot up here is the approximation of the stock to flow ratio to the market cap value for this era that we're currently in, placed on this linear relationship. And in this one as well, which was done a year or so later by 100 Trillion Plan B, you can see that silver, gold, real estate, and diamonds also have a very close linear relationship, which is just all super fascinating. And all the little red dots in the back here, you can see gold yearly values and the gold cluster very tightly grouped over here, which is a fantastic example of that relationship between the gold market value and the stock to flow of gold being very tightly correlated. So yeah, if we can look and we can say, well, using the inflation values, using the stock and the flow, we can essentially get a stock to flow ratio here, and we can say, okay, if we know what it is and we have the linear relationship, then what is the market value? We go over to the side here and we say, well, if the market value is such and such, and we know exactly how many Bitcoins there are in circulation, then logically we can derive the estimated price, which is the next thing that we're going to be looking at. So stock to flow as a price estimator. This was the original stock to flow ratio plotted as like literally a price chart where you can see here the purple line in the background. We would have the halving events where the value of the stock to flow would jump up quite quickly, and the variability is representing the hash rate moving around. So then we have big jumps, and the price is kind of attracted to that. And you can see that's the idea behind it anyway, that every time we have a halving, we have a supply shock that's reflected in this stock to flow ratio, which in turn drives the price up in order to sterilize that imbalance between supply and demand and have that scarcity reflected in the price of the asset. You can see over here that we're currently just below the predicted stock to flow ratio for the original model, which is the most conservative one out of all the different models. There's a couple, but there's only really two major ones that we'll be looking at. And you can see here, this is the second one, the cross asset model. So whereas the first one has an equilibrium price of about $100,000 per Bitcoin, The cross-asset model has a equilibrium price of about 280 to $300,000 per Bitcoin. And of course, one of the interesting historical features of the price as well is that it seems to overshoot the stock to flow ratio in each era. Now, whether or not it'll actually get to that or go past it, that's subject for debate. You can see here that we might have diminishing returns for each era. It goes far above the stock to flow over here. It goes quite far above over here, but not very far above here, at least with the cross asset model. With the original one, the relationship's a little more better, a little more tight. We have an overshoot here, an overshoot here, a decent overshoot here. We might just hit the line. We might only see Bitcoin to $100,000 or $200,000 at its absolute peak. But yeah, it's a good way of approximating what the supply and demand dynamics of Bitcoin look like over the long term, because we can't know the demand unless we are like gods and we can look into the psychology of the market and know what every single participant is doing. But using the supply dynamics, which are known, gives us a great base to work from to try and figure out where things are moving. So what we're going to do is we're actually going to think about how we can apply this to trading. So obviously, if you remember this from one of my earlier videos, what we're trying to do is we're trying to find positions in the Bitcoin price where we have the absolute most upside potential available to us. This will enable us to take on more risk or maybe change our position sizing to better reflect a high probability opportunity that can also make a high magnitude gains. So, for example, these two squares down here are places where I would be looking to incorporate the stock to flow model to see whether or not we have an outsized opportunity to make money. Over a long enough period of time, this is kind of what we're looking for. We're looking for these spots here. Thankfully, using the stock to flow model, we have actually a pretty good model of looking at that. So if we actually take the price of Bitcoin and plot it against our expectations of the stock to flow, we can get a stock to flow multiple like this. It's like an oscillator that moves around zero, which is the predicted Bitcoin price. And we can see areas where the Bitcoin price is far higher than predicted and also far lower than predicted. And this can give us good examples of places that we should be paying attention. Here, I've done my best to line up the charts so that you guys can see where exactly I'd be looking for opportunities to add large sizes to my positions, especially if I was swing trading to have my conviction very high. You can see here that I've got the green lines linked into locations where the price has declined below the stock to flow model equilibrium line. And yeah, the historical hit rate is being quite good, obviously. There are some criticisms, though. Criticisms that this model is overfit and that it's just a sheer coincidence. So we'll have a quick look at that. Future projections. Because the inflation rate of Bitcoin is destined to hit zero eventually, with a stock to flow ratio of infinity, the stock to flow ratio therefore predicts a final price of infinity. Clearly, this is not correct. Logically, at some point, there must be diminishing returns to scale. Whether this happens slowly over time or suddenly at some point in the future is unknown. We have to take this into consideration, that there may be diminishing returns, significance, and cointegration. There have been many mathematicians who have run different analysis on the different variations of the stock to flow model to find that there is no cointegration between stock to flow and price. This essentially means the stock to flow model cannot be disproven and may be coincidental. As a result, it falls outside the verifiable scope of the scientific method. And as we all know, the scientific method, one of the core principles of that is that for a theory to be taken as law, it must be able to be disproven. Failure to do that means that you cannot take a model seriously. However, these are a few comments from one of the mathematicians, statisticians that did most of the work on proving and disproving the stock to flow model. Even if stock to flow ends up being garbage or another rainbow chart, there are plenty of other reasons Bitcoin will continue to outperform every other asset. There is no stock to flow, there is no model, there is only rocket fuel. The model may be correct in principle, but it can never be proven. Now, if you're thinking about all this and you're thinking, well, this sounds pretty grim, Adam, and I'm not sure if I can trust it anymore. The thing is about the stock to flow model is that it's a tool. It's a tool in our tool belt, but it does a great job of conceptually explaining why the Bitcoin price does what it does. And it takes into account all the variables that you would logically think would make the price react. It takes into consideration the constriction of supply. It takes into consideration the total available supply of Bitcoin. There are more advanced models that take into account lost coins and coins that are basically, yeah, locked in wallets forever that can't be recovered. And those models are pretty interesting to look at as well. But yeah, if it's just another tool in our tool belt. Essentially, what we're going to be doing over the course of this swing trading masterclass is collecting as many different models as possible. So even if one breaks, then we'll be able to revert to another one. I still believe wholeheartedly that this model is actually very useful. Conceptually, I think it makes perfect sense. And yeah, I know that the diminishing returns will absolutely come into it over time. Looking at the stock to flow cross asset model and how much higher it is than the original model, I'd say it's probably a bit too optimistic. Let's be honest. We might enter a phase of the Bitcoin maturity where we just have extended market cycles that just go a lot flatter out into the future like this instead of having huge run-ups. And as a result, most of the volatility may move down into small caps. But that's something that we can look at into the future. Essentially, we're just looking at this and saying to ourselves, how can we use this as a good tool? You can see recently, we actually had a huge amount of deflection away from where the stock to flow predicted price should be, which to me screams great buying opportunity. Whether or not it's perfectly accurate, I think that it makes a lot of sense. With that being said, prepare for unit number 5, where we keep expanding our price model toolkit. If you have any questions, please jump into the Crypto General chat or Crypto Questions and hit me with the @tag. Thank you very much, guys. Talk to you soon. Hello, and welcome to Adam's Swing Trading Masterclass. Unit number 5, Enhanced Long-Term Components. Today, what we're going to be doing is expanding on the other long-term components that we use to enhance our analysis of the stock to flow model and how we can essentially complement it and just make sure that we've got the highest possible signal and that we're covering all of our bases. The metaphor I like to use is having a lot of tools in your tool belt. Otherwise, every problem that you come across, if you've got a hammer, just looks like a nail. We're trying to avoid that. We want to make sure that we've got redundancy built in so that just in case one of them stops working, we've got other tools to rely on. Disclaimer: any views or opinions in this course are strictly my own. I'm not a financial advisor and this is not financial advice. Tactics, strategies, philosophies, and fundamental principles presented here are mutually exclusive with material presented by the other professors. This is because my methods target different goals using different data. So, remembering this slide from Unit 1, what we'll be going to look at today is basically a mix of macroeconomic and on-chain data. We had a look at the fundamental laws of economics in the last one with the stock to flow model. And we're going to be moving on. So we're going to be trying to move down this thing gradually. So these are the learning objectives for today. We're going to be looking at macroeconomic correlation, the CVDD realized cap metric, reserve risk metric, the Puel multiple metric, the MVRV Z-score metric, and the R-HODL ratio. Macroeconomic correlation. Bitcoin as a global asset. The relationship between Bitcoin and the global economy went largely overlooked and undetected until COB Bitcoin futures started trading in December 2017 for what was essentially a very obscure speculative asset at the time. With no known use in the economy, some short-term price correlation started to bleed through from the stock market. You can see here on this chart, we started to have a lot of very coincidental correlation coming through. Very interesting. I know I found this very fascinating when I first saw it. It's pretty much triggered my obsession with trying to find correlations between assets. I believe the main cause was institutional adoption, as the lack of long-term correlation between Bitcoin and stocks made it an excellent portfolio diversifier despite its high volatility. I remember FundStrat's Tom Lee was actually the first to publicly identify this by calculating that a small allocation to Bitcoin in a diversified portfolio not only increased returns relative to stocks, but also reduced portfolio standard deviation, which, as I explained in the altcoin selection lecture, is actually a measure of risk. So if we have a quick little look at this return profile here for all these different portfolios, you can see that with the S&P 500 in gray, if we have a diversified portfolio where we actually have equities and bonds and include Bitcoin, not only do we receive higher returns than stocks, but we also have less risk. It's absolutely incredible. It's super fascinating, super fascinating. You can see that with these results, thousands of competitive investment banks, private equity firms, and hedge funds would be naturally drawn to an asset with these beneficial portfolio characteristics. After all, nobody's going to leave money on the table, and especially if people are trying to compete for the lowest risk rewards. It just wouldn't make any sense not to use it, right? So logically, portfolio managers will acquire Bitcoin and dynamically rebalance to their exposure to their value at risk. So it's within acceptable boundaries. Excuse me. This is standard industry practice and is based on the implied volatility of the portfolio assets to estimate the probabilistic maximum loss they're exposed to on any given day. With extremely large and sometimes illiquid holdings of stocks, bonds, and infrastructure being a core part of institutional portfolios, managers gain the greatest benefit in portfolio safety per dollar, which is agility and total VAR reduction, by selling the riskiest assets first. With Bitcoin now available and traded at a high volume, it has leapfrogged into a risk category above stocks. Consequently, managers will sell their Bitcoin first when stock market volatility rises. This would explain why Bitcoin has become more closely correlated to the stock market. Here I've put a couple of charts together just to show you how occasionally we do have highly correlated moments with the stock market between Bitcoin and the stocks. So there's one there. COVID crash was another big one. I remember this was causing a lot of people to freak out. People saying, "Oh, but store of value, and it's meant to be protect the holders and all this type of stuff." At the end of the day, if people are going to be using Bitcoin as a portfolio diversifier, it's going to be correlated to the overall stock market at some degree. Bitcoin is essentially the index fund for the cryptocurrency market, while it stays number one at least. And potentially Ethereum could replace that, since it has so many other smaller finance platforms built upon it. But yeah, when we have massive recessionary declines in the stock market like this, or large volatility spikes, it's absolutely going to be correlated. We have some long-term correlation there, where we have the drifting up over time of the assets together, stocks and Bitcoin again. But that being said, we do have periods of time where they become uncorrelated and they move in opposite directions. So I don't want you guys to think that it's some sort of magical ability that they're constantly moving together all the time, because it's not like the correlation between cryptocurrency assets. It's not simply a case of they move in the same direction at all times, which cryptocurrencies themselves mostly do to each other. With stocks and Bitcoin, the correlation and the relationship is a whole lot less stable. So it essentially looks like this. If we're looking at the correlations over a long period of time, I just want you to focus on the black line for a moment and see that the correlation does not remain between 1 to 0.8, or up in the top 1/4 of this chart here. It dips to zero at some points and even negative correlation at other points as well. And we can kind of see this relationship playing out with the US dollar as well and gold. The US dollar is an important one to a degree because if you think about it logically, this Bitcoin is priced in dollars. So therefore, if dollars become stronger, then Bitcoin will conversely become weaker. So you would expect to see a persistently negative correlation between Bitcoin and the US dollar, which is what you see over here for the most part, which makes a lot of sense. When they become highly correlated, that would be considered unusual. So that typically doesn't happen. But you could generally expect that for the most part, you will have a positive correlation to stocks and a negative correlation to the dollar. I would also potentially suggest that we should be expecting negative correlation to gold over a very long period of time. I'm not quite sure if I would expect short-term correlations to gold to remain persistent, but that's something that we should look at a little bit further. So. Um, the implications of all of this analysis would suggest if one can predict stock market volatility during times of high correlation, then predicting the movements of Bitcoin would be significantly easier. This is even more powerful during extreme bouts of volatility, such as the COVID crash, as we all know about. A caveat to this method is that stock market timing is still a highly speculative venture and cannot be taken as a guaranteed source of future price information. This being said, several methods can be overlaid onto this hypothesis to gain an idea of potential future movements. So, looking at the stock market specifically now, we're going to be just going over a couple of different recession models that you might want to look at if you're worried about giant declines in the stock market bleeding through into Bitcoin. This is all part of how to set up the understanding of how Bitcoin works as an asset in your mind. So, probably the first and the most important one is the Conference Board Leading Economic Index. Historically, it's been pretty good at detecting recessions before they happen. For the COVID crash, it wasn't very accurate. It wasn't a good leading indicator because it was very much a black swan event where we just had a sudden contraction in economic activity where all the expectations suddenly caught up with us. So potentially useful in the future. I know the methodology is tight and it's well designed. So yeah, potentially something to keep your eyes on. The Chicago Fed National Activity Index. This one is more frequent than the leading economic index. So this one's coming out more frequently. It reacts a lot faster, although the trade-off is that it's a little bit more noisy. So depending on what the rate of change is compared to historical information, you can see the whiplash here is quite strong. But generally, if you go to this website, the Chicago Fed National Activity Index website, that will give you thresholds to look at, so that you can approximate where the recessionary levels may be. It's a little bit hard to get into, but if you go on the website and you go through all the different charts they have, you'll find that I think it's 0.7 or something is the threshold they normally look at. So if you have the average of all the readings and it's starting to drift lower and it crosses below 0.7, that's when you start to let the alarm bells ring a little bit and say, well, maybe I need to be a little more sensitive to what's going on in the stock market. Another one I like to look at is the baseline rate of change analysis grid. You can get that at econpi.com. You can either look at the 3-month rolling average or you can look at the instantaneous readings. The instantaneous readings can be a bit noisy. The 3-month one is normally the one that I like to look at. Market PMIs. This one is probably for the more advanced people who are interested in stock market analysis and econometrics. PMI is a rate of change measurement and is very, very popular in the stock market world for trying to figure out exactly what's happening in the economy, where the expectations are coming through from the companies themselves, whether or not they're increasing prices, getting more orders, things like this. Very classic way of measuring economic performance. If you have, well, I mean, this is a great example here. You can see in the great global financial crisis, we had a cross below zero, and then a move into contraction at about the same time the stock market started to decline. Also, as the expectation started to reverse, and it was bad, but it was less bad coming up above 50 because 50 is the midline. Rate of change, it's GDP. Anyway, so yeah, coming up above, like it's becoming less bad over time. That was about the trough of the global financial crisis, and you can see an expansion, and then we have enormous declines yet again in the PMIs. This was lagging as well, but in normal recessions, it does give you a good idea of what's happening in the economy. You can read the qualitative reports as well, and they'll tell you a whole lot about what's going on in the economy. The Investopedia Anxiety Index is actually an interesting one. This is probably more frequency. I think it's updated on a daily basis. So when it starts to increase in value, that's normally when my ears start to perk up. This is actually a really good one if you don't want to get too bogged down into how economics works. This is a great one to look at. You just Google this, you'll be able to find it easily. When the anxiety index peaks like this or starts to have a bit of a run up, that's when you can say that, oh, something unusual is happening. I better keep an eye on this. Recently, we've had a lot of talk about a stock market decline. The volatility in the stock market is very low, which is normally a bad sign. I wouldn't be surprised at all to see this fly up, see some more volatility. And yeah, like I said, that may or may not bleed into stocks. Cryptocurrency. And another one, this one's another good one for people that don't want to get too involved in economics. If you go onto TradingView and you find the indicator VIX correlation, just pump that onto your chart, you'll see that anytime the stock market on the daily time frame starts to generate a bit of positive correlation to the VIX, it's normally an indication that something's not quite right. You can see here the hit rate has been pretty good. If we're being honest with ourselves over here, we probably had a bit more of a signal over here. I put it over here because I was complementing this with a whole bunch of other shit when I front ran this crash. For those who were in the general chat, you'll know that this is from my story about my first six-figure loss. I shorted the market at this exact point here. It was immaculate. Held on, made all this money down here, and then held on as well as it came back up because I was like, surely it's just going to continue going downwards because the whole economy is destroyed, and it just went up forever. So yeah, pretty bad situation. Learned a lot from that, honestly. It was all about how I can increase the probabilities of my processes. It's one of these things like you want to learn from somebody like me, somebody who's not only lost lots of money and made it back, but also a person who used the experience to create a robust system. You see, I said to myself, I'm never going to experience something like that again. I absolutely must engineer out the problem that I faced here. And normally people fall off the wagon if they have a big loss. But I was like, nope, I need to systemize this. I need to figure it out. And I did, and made the money back, no problem. And yeah, again, if we're just looking at this type of stuff, you can see again over here. Great signaling. Obviously, no one tool in isolation is perfect. I wouldn't consider this one perfect at all. I mean, look over here. It said that the top was over here. Not accurate at all. Over here. You need to be using things like this with complementary other indicators so that you can maximize the probability of getting the call right. So getting onto paid models, if you sign up for services such as 42 Macro, what they will do is they'll actually give you macroeconomic forecasting that's aggregated in this grid format here. So you can see that for July, August, September, we have the quadrant of deflation over here, which is bad for risk assets. So if you know that we're heading into another month or two of potentially bad economic data, then what you can do is you can set your expectations for that. Whereas, for example, if you were over here and the quadrants were saying, I don't know, let's just make something up. Say they were in reflation or Goldilocks and they were hovering between these two, and you're saying, well, shit, that's where growth is increasing. Then if you receive this signal here, and you'd be like, well, I can expect for the next 2 months that I'm going to be receiving growth. So this is a great buying opportunity. Whereas maybe if you're over here and you're seeing that you're entering deflation for a month or two, you'll see this here and you'll go, well, this isn't a good buying opportunity because I know that growth is going to be a little bit suspicious over the next month or two, whereas growth is going to be very strong for a month or two after this. This is another way of figuring out when you might be entering a regime of particular sensitivity to the market. If you're coming over here, or I don't know, it could be anywhere really. If you're coming over here and it's saying, well, you're about to enter some deflation, you're going to be going, well, the next stock market decline is going to be particularly violent, so that might be a good candidate for it to bleed over into the cryptocurrency market. This is all about avoiding risk, and yeah, so you can kind of get where I'm saying there. If you're going to be having a decline over here and it's not too violent, then it may not correlate into Bitcoin. But if you're going to have one over here that's particularly violent, then it's probably going to be correlated to Bitcoin, and you can use the economic forecasting to kind of determine the probabilities of that happening. So yeah, I'll just touch on the inverse relationship to gold quickly. Another factor to consider is whether Bitcoin can replace gold as the world's inflation-powered store of value, which is a popular narrative for Bitcoin due to its supply dynamics. Often the correlation is negative, but not consistent. So the relationship is worth watching. There's a lot of arguments to be made that potentially Bitcoin can suck capital out of gold so that the two will kind of oscillate inversely to each other as capital sloshes in between, but the long run correlation stays negative as Bitcoin grows and gold shrinks. Whether or not that's possible, I don't know. It's something to keep an eye on, though. It's something to keep in the back of your mind. Right, so now we're going to have a look at some on-chain indicators. We're going to blast through this one. The macroeconomic stuff was going to be the longest section, so we'll just blast through these very quickly. I want to just touch on one thing and let you guys know that you don't need to know precisely how these are calculated. I'm just letting you know how they're calculated so that you can say, oh, that's interesting. It's more of a novelty really than anything. All you need to know is how they behave and how you can use them. So let's continue. So the cumulative value days destroyed has historically picked the bottom of the market. When coins pass from old investors to new investors, the transaction carries USD value and also destroys an amount of time the coins were held by the previous holder. CVDD is the cumulative sum of this value time destruction. Realized cap is the value of all coins in circulation at the price they last moved. In other words, an approximation of what the entire market paid for their coins. In the following chart, realized cap is mapped to the price domain by dividing by the local coin supply. So, if you have a look at these two models, and you can see, you can source this from Webull, Webull.com. If we're looking at Bitcoin over a long period of time, this model actually has the ability to predict bottoms as well. So if you're combining this with other measurements and you're seeing the price decline and it starts to approach these models, you can say to yourself, well, it looks like it might be a good full cycle buying opportunity. Whether or not these stay accurate into the future is subject for discussion. And again, it comes right back to the point that we need to have a lot of tools in our tool belts just in case some of these don't work into the future. So this is a good one to add to your collection. Reserve risk. Reserve risk is a complex calculation attempting to categorize the implied risk of coin movements between holders as a function of their held time and coin market values. It is calculated as price divided by the cumulative change in value adjusted coin time. So you can see here, the value of Bitcoin price is the dark blue line back here, and we have MVOCD as the light blue line here. Reserve risk is the difference between these two. And you can see that as reserve risk goes into the red zone up here, you can see it's pretty much consistently marked cycle tops. And we have cycle bottoms marked down here as well in the green. It's another great one. 12 multiple. This metric looks at the supply side of Bitcoin's economy, Bitcoin miners and their revenue. It explores market cycles from a mining revenue perspective. Bitcoin miners are sometimes referred to as compulsory sellers due to their need to cover fixed costs of mining hardware in the market where prices are extremely volatile. The revenue they generate can therefore influence price over time. The Pearl multiple is calculated by dividing the daily issuance of bitcoins in USD by the 365-day moving average of daily issuance value. You can see here it's a bit noisy, however, as it would be because it's following hash rate, following the inflation rate, which is a function of the hash rate. You can see here that in the red and green zones, we have exceptional signaling capabilities for buying areas. I mean, my God, look at that. I mean, let's be honest here. Jesus Christ, that was an awesome entry, especially recently. And some high frequency locations. It's self-explanatory, really, isn't it? MVRV score, my personal favorite. This is the variability standardized difference between market cap and realized cap. It strips out the short-term market sentiment that we have within the market value metric. It can therefore be seen as a more true long-term measure of Bitcoin value. Which market value? That's not right. Anyway, self-explanatory again. We've got incredible buy zones, incredible sell zones, basically sniper level sell zones. Should have maybe drawn a line across here and said, is that getting a bit overheated for this one over here? Don't know. Maybe it can be adjusted in the future. But anyway, let's continue moving on. The R-HODL ratio. In summary, the realized value HODL waves are different H bands of UTXOs weighted by the realized value of coins within each band. The realized value is the price of the UTXOs when they were last moved from one wallet to another. The R-HODL ratio looks at the ratio between the R-HODL band of 1 week versus the R-HODL band of 1 to 2 years. It also calibrates for the increased hodling over time for lost coins by multiplying the ratio of the age of the market and number of days. When the 1 week value is significantly higher than the 1 to 2 year value, it's a signal that the market is becoming overheated. You can see this one here has quite a high signal to noise ratio, and while we have a declining signal over time, and you can see here this one's literally off the charts and these two are getting lower, so it's kind of coming down like this. It still does give us a decent idea of where we are in the market. This one's interesting. See how it didn't decline very far on this latest one here? This is one of those metrics that gives me the impression that we may be in the market for a double cycle like over here. Because if we draw this line down, we probably still need this value metric to come up over here somewhere before we can be considered peaked. And it doesn't seem to be that heavily affected by the magnitude of moves. I mean, it is to a certain degree, but this leads me to believe that we could still have another massive run up in Bitcoin to at least 100 to 200,000, and would still be easily within the confines of what would be expected by this value metric here. Right, so prepare for Unit 6, where we expand our shorter-term price model toolkit. If you have any questions, jump into the Crypto General chat or crypto questions and hit me with the ad tag. Before you get too despondent, I just want to double down on a certain point here. I know that this is all incredibly intense. What I want you guys to remember is that all this stuff, I'm going to be giving you a system for this stuff at the end of the Swing Trading Masterclass. What I'm trying to do is I'm just trying to is basically walk you through all the different measurements and how I evaluate the risk and the price probabilities for Bitcoin. So don't despair. You don't need to absolutely master this straight away or do a whole bunch of research yourself, unless you want to work hard and front run me. That's okay. I mean that literally. Like, you can go to the website looking into Bitcoin, and you can bookmark all of these if you want and try and develop your own system. Because obviously it's going to take me time to develop all these lectures and everything. But at the end of the masterclass, what I'm going to be doing is I'm going to be aggregating all this shit for you and putting it into a giant spreadsheet, and kind of trying to provide you with all the different resources that you need in the one place. So yeah, just make sure that you're looking at these, having a think about them, but don't get overwhelmed. because I will be providing more support to you guys over time. I'm not just kind of piling in a whole bunch of crazy shit and then kind of sending you off on your own. I'm going to be taking care of you more into the future. All right, so yeah, if you have any more questions, by all means, as always, please hit me up if you have any questions relating to the material, and I'll talk to you guys soon.